Hello and welcome to Crux Investor. We caught up earlier today with Mark Gray. He's the chairman and MD of Allegiance Coal, ASX listed. They have assets in Canada and also Colorado down in the US. And that's the asset we talk about today. They've just raised $25 million of equity, having chosen to reject a debt term sheet. We talked to them about when they're going to get into production. Apparently, they're going to be cutting coal in April, getting it on a train in May and delivering it to port and getting paid in June. So lots going on. They're hitting the targets that they said. We talk a little bit about market conditions. And here's an idea for you. Would you consider met coal as a critical mineral? We discussed that. And if you want to hear our thoughts and opinions on the conversations, topics discussed, and the company itself, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. There's commentary from experts from around the world on a variety of companies and commodities, including critical minerals. We've got training courses to help you with your diligence process. We've done summaries of all the interviews that we've done to help you with your research and save you some time, because we know you're busy. And if you want to join a thriving community of investors sharing their thoughts and ideas with each other, a nice, friendly and safe environment free from judgment, trolling and abuse, you can join them at cruxinvestor.com/club. I know you'll like it. We'd love your feedback too, so give us a like. We appreciate it. If your thoughts below, get back to everyone. And if you want to see what we talked about today, take a look in the description below. Mark, how are you, sir?
I'm well, thank you, Matt.
Good to have you on our little humble show. Again, we're going to talk about coal. It infuriates some and excites others in equal measure. How have you been? It's been about 6-8 weeks or so. All good?
Hectic, very hectic period. Obviously raising startup capital, getting the mine ready for production, refurbishing equipment, organizing logistics, port arrangements, rail arrangements, and obviously the client who buys the coal. So yeah, very hectic, very demanding, but very exciting.
Good. So you're still in Canada, but we are going to today focus on New Elk, the US asset, because you've been raising some money, and I want to talk to you about why you've done it like you have. But before we do, can you give people a 1-minute overview of your business for those new to the story, and I'll pick it up from there.
Absolutely. Allegiance Coal is an ASX-listed company focused on developing metallurgical coal assets in Canada and North America. One project in British Columbia on the western side, which is a greenfields project currently going through the permitting phase. And then, of course, last year we completed the acquisition of the New Elk coking coal mine in southeast Colorado. And we are very much focused on returning that asset into production over the coming weeks.
Yeah, well, there's the thing. You told me May, June, when we spoke last, you'll be in production, cash flowing, which is an exciting moment. But you were talking to me about term sheets, debt, as a way of funding it back then, 6 weeks ago. But you've chosen not to go down that route.
All changes, hey?
Yeah, things change. So why have you chosen to go down the equity route?
So it's well publicized in our ASX announcements that we had a $25 million debt term sheet from a New York debt fund. That fund was undertaking due diligence, was nearing the completion of the due diligence, actually. In my capital structure, I always had a shortfall between the amount of debt I wanted. I didn't want to borrow the full 25 million. I had 15 million in my mind, as far as gearing the balance sheet is concerned. And so I always had a small shortfall, which I needed to fund by way of equity. So as the debt process neared completion, in fact, as we spoke last time, though it wasn't public information, so I couldn't go into that much detail, I asked my brokers to reach out to institutional investors to see what interest we could get, by way of an equity placement. We went out looking for 10. We got 15 Aussie. And a week later, after we completed that placement, a European equity European fund manager reached out to us as well and said, we'd like to be involved, and we raised another 10. So all up, we raised 25 million. We went for 10 and we raised 25. So we had fantastic support from the equity markets. Obviously more shares on issue, but being equity funded to start up a mine gave myself and the board a lot of comfort. So we didn't need the debt.
Okay, a lot of comfort means what? I'm just intrigued, and I also want to help educate people as to why companies make certain decisions, because obviously debt is less dilutive, but debt comes issues. But you're going to be cash flowing, so I just want to understand why it gave you and the board comfort to go down the equity route precisely. If you don't mind sharing that.
So typically, I think when you're starting up a mine, to go 100% equity is always too dilutive, because you are typically building a mine. So normally you're looking at a $200-300 million capex exercise. So there's always got to be an element of debt in your capital structure, right? We are fortunate in that we acquired an asset that is already built. So there is something in the order of $200 million worth of capital expenditure in the ground. So our startup capital, I think as I discussed last time, was about 10 million going into refurbishing equipment and refurbishing the mine, the wash plant, and the balance was working capital. So I only needed something in the order of about 20 to 25 million of Australian dollars. And in the overall scheme of things, that's not a lot when it comes to equity funding. So we chose to take that route, given that the interest and the money was available, rather than drawing down debt. And that, for me, as the CEO of the company and for my directors, it gives us comfort. I don't have a project financier leaning over me and leaning over the board. I'm not bound by any banking covenants, and I can just focus on the business.
Right. So no external pressure, even though you expect to be cash flowing. It's the kind of what if scenario. You didn't want to be put in a position of difficulty. Okay, I get that. But the startup stage is critical. It's absolutely fundamentally critical to it. It sets the tone, not just of the business, but in the market, the expectation of you. If you get this wrong, that's you branded and labeled for a long time, right? So do you think that the market has or will, because I know you've still got to kind of close the last 10 down or get approvals for the last 10. Has it reacted positively to that route, or are they worried about dilution?
No. As far as the dilution is concerned, it's a strongly held view amongst my shareholder base that taking a conservative approach to start up your first producing asset is a wise thing to do, and they're totally supportive. When interest came in for the second component, the 10 million, I reached out to some of those institutional investors who came in when we did the first 15, and they didn't hesitate to suggest to me that you should take that extra money.
Okay. So talk to me about the market at the moment, because it's a funny old time. You've got China paying twice the price it probably should be, because it's having a little bun fight with the Aussies. And, I think that, I know you say it's settling down again. That's what you said to me last time. That it's the players are known, the games are known. It's all good. But I'm wondering why you were even considering, given what you just told me, a debt component versus just asking the market, can you fund me, please? What's changed? What's moved? What's evolved? What do we need to know?
Yeah, really nothing's changed from our company's perspective, from our mine's perspective. If you're a Canadian producer of coking coal or a US producer of coking coal, the demand for your product remains strong at prices equal to China CFR. So US Canadian producers are getting value for their product. It's just the Australian mines which remain severely discounted against China CFR prices.
But something must have changed because you weren't considering equity before. Sorry to labour the point. I'm just fascinated by the decision-making process of companies. In this case, you. Why weren't you going out and hunting down equity before? Why did you got a term sheet, which was a debt term sheet, on the table? Why was it sort of last-minute switcheroo there?
Well, we didn't anticipate the level of equity interest. Simple as that. And we were overwhelmed by interest, and we accepted it. Okay, I'll leave it. I don't want to be a dog with a bone here, but I'm just, again, I'm trying to understand if there's something that we as investors need to understand about changing landscape on the macro front, or if it's just an internal decision by you guys to move to another solution. Sounds like the latter. Okay, so are we still hitting May, June timelines for production, cash flow? We will we'll start cutting coal the week of 19 April. Week commencing 19 April. We'll be loading our first train probably the second week in May. And we should have around about 80,000 tonnes landed at the port in New Orleans by the second week of June.
Okay.
So we're targeting early mid-June for our first shipment.
When do you get paid?
I have an offtake financing arrangement with my sales and marketing agent. So my agent will pay our company for the coal when it's landed at the port.
Okay, there you go.
That facility is of enormous value to me. It brings forward my cash flow by several weeks, and then of course my sales and marketing agent will then recover payment from the steel mill itself, and that the sales and marketing. The commodity trading firms have excellent relationships with the steel mills. They know the steel mills intimately. They're comfortable to take the credit risk with the steel mills. They understand their payment terms. So it's one area of the cycle I just don't have to worry about. I get paid when I put the coal on the ground at the port.
Fantastic. Okay, is that? I know we're talking about. Well, I think you were talking about 1.5 million tonnes per annum annualized. From June onwards, is that offtake 100%, or have you got options to go to the equivalent of spot?
Yeah, so we will start with spot in the spot market with spot cargoes. We are still yet to undertake drum samples and in some cases possibly trial shipments with the steel mills. We made a decision to start the mine up in the spot market. We could have delayed our startup and gone through the process of mining coal to recover coal for samples. Given the liquidity of the met coal market, it's a 320 million tonne seaborne market. Given its liquidity, we decided to just get the mine into production. There are steel mills who will buy our product without drum samples or trial shipments. So we'll initially start with the spot market. During that time, we will do sampling with selected steel mills, people who we want a long-term relationship with. And then we'll prepare ourselves for steel mill procurement for next calendar year. So the steel mills in the last quarter of every year will line up their supply for the coming calendar year. So October, November is when we'll lock in supply arrangements for next year. So the timing's good. If we start in June with our first shipment, we can get about 3 shipments away before we sit down and have serious conversations with selected steel mills for calendar year 22.
Right. Okay. So 92 million market cap Aussie today. Share price, let's say moving sideways. You had a really nice bump from, I think, when our club members got early access to it. I think there's a few people dipping in there. You went up to 11 cents at one point. But it's moving sideways at the moment. So people aren't there yet. What do you think the moment's going to be when you actually start cutting coal, when you actually land at port, or you actually start doing additional contracts in market?
Obviously, I can't predict how the share market performs. I can only focus on my business, which is, getting coal to the port at the price that at the cost that we believe it should, and selling it on the market, in the current pricing environment. And if I do that, then we're able to generate strong EBITDA earnings, and then hopefully the market can reflect on what our margin looks like, and sit down and do their multiple valuations on us, and make an informed decision.
I noticed you haven't got yourself an IR company yet. What do you think that the perception in the market is that coal is still a dirty mineral? We've done a series in our club about unloved commodities, unloved investments. Coal's one of them, right? Tell you now, right now. It's very emotive topic. Are you finding it hard to find people to come and work with you?
People I want to work with, yes. There are plenty of IR companies out there. And I have been approached by many, but I just haven't been convinced by the value that they really bring. And some of the people who I observe in this sector, working with companies, reaching out to them, quite frankly, they're all in love with battery minerals, and it's hard to drag them away and get them back into dirty old coal. But I continue to perform that function myself. My shareholders like it because they have a direct relationship with me. It is demanding, particularly as we go into production, and workload generally is going to increase exponentially. Listen, Matt, it's something I'll continue to work on. For the time being, I take responsibility for investor relations.
But the reason I ask is because I think it's a really interesting point. We've got a piece coming out in a couple of weeks, which is talking about met coal. That's what we're talking about here today, folks. Met coal and its role in producing stainless steel. It doesn't happen. Stainless steel doesn't get produced without met coal. Okay, and without stainless steel, there's a whole bunch of stuff that everyday folks are not going to have every day, from phones, cars, trains, you name it. Okay, so I don't mean to sound glib about it or patronizing about it, but in that sense, met coal is a critical mineral. It's not on most people's list as a critical mineral, but it is, and I think people need to start viewing it that way. And I think people like you need to start talking about it that way, because that is how important it is to the global economy. Yet, IR people in this industry don't understand that. Not all retail understand that. And that's fascinating to me. It says that people aren't listening.
High quality steel, which is blast furnace steel, not scrap metal steel, electric arc furnace. We're talking blast furnace, is inextricably linked to the battery mineral space. Right? It cannot advance, it cannot proceed, it cannot come to be without having high quality hard steel. So you make a good point. I hadn't really thought of it in those terms, other than when I just listened to you now. But they are indeed inextricably linked.
Let's come back to you. What are the impediments to you actually delivering coal at port come the end of May?
Well, the supply chain is in place. As I said, mine refurbished, workforce mobilized, equipment ready. The underground entries have been opened. Our staff have gone underground and are rehabilitating the underground workings. Rail is in place, port arrangements in place, sales and marketing has commenced. What is the impediment? As I sit here now, I can't see it, but I'm prepared for anything. I guess, it's really now about getting those spot cargoes moving, right?
Yeah, it is. Look, I appreciate the update. I'm glad things are moving ahead. And more importantly, I'm glad you got the right type of financing in place for you to allow you to do your work sort of unimpeded, unencumbered. Stay in touch. Let us know how you get on. I'm looking forward to your first transaction, your first sale into the marketplace, and maybe the first of many. So I appreciate your time today. Thank you.
Thank you, Mick.